Okay, as promised, I am going to make a quick video that I think will assist people understanding how our international banking systems work. The common term for the mechanisms by which the banks operate is fractional reserve banking. So what I'm going to do here is we're going to follow a $10 injection, and for the sake of this illustration, we're going to use physical cash. You can extrapolate further how things may work in completely digital terms, but for now we're just going to focus on using digital and physical cash. Okay, so first, I want to just kind of familiarize you guys with the terms and so forth, and some of the little illustrations I've made on the whiteboard here. Okay, so first and of utter importance is the legend down here. Okay, so the little tick marks that are in black, that's going to be the actual ledger. So there's your account, and you in this case would be the depositor of the $10. There's the bank, which acts as an intermediary, and there's the borrower's account. Okay? And so remember these. Black indicates digital, green indicates physical cash, like this. Physical cash, like this. Okay? Green, we got it. All right, so now we get started with the injection of the $10. So here at the top, you have $10. This $10 is injected into a bank or a bank account, okay, into your account. And so basically what happens is as follows. So initially the $10 goes to the bank, they create an account for you, and you have your account. And this $10 initially was in your account. But the way fractional reserve banking works is as follows. So what the bank do, there's laws on the books. Banks are required to simplify, there's a thing called a reserve requirement. But to simplify, all that means is banks are required to hold 10% of their depositors' money in the bank itself, meaning they can't lend it out. So for every $10, they have to hold $1 in the bank. They can lend out the other 9. So this is actually how credit is created. Most commonly, we're associated with credit creation through the central banks of the world, Federal Reserve, the ECB, the Bank of England, Bank of Japan, etc. But here's how fractional reserve banking works and how credit is essentially created out of thin air. So this $10, physical $10, goes into the bank, okay? So they open an account for you, okay? So here's your account. What happens though is once the money is in the bank, or while the bank has control of the money, due to that rule that I described earlier, they're only required to hold one physical dollar. So a borrower comes along, wants to open a restaurant. The borrower is able to borrow the $9, okay? Or they can borrow $9 of the $10 that was initially there. You know, and obviously they're going to borrow that. They're going to use that for things like rent, salaries, supplies, I don't know, hamburger buns, napkins, cleaning supplies, things you need for a restaurant. And so once the bank lends out your money to the borrower, this is how the breakdown works. So in your account, you still have a claim to those $10. So your ledger is going to show, digitally speaking, $10. However, over on this side, and I accidentally created one more than I should have, the borrower's account is going to show $9. That's how much they borrowed from the bank, where you deposited your $10. So the bank's required to keep one physical dollar here. You clearly have no physical dollars. The bank has one of your physical dollars, and the borrower has 9 of your physical dollars. And so basically what's happened here is they've got the money, but you have 2 entities with a claim to the original $10. And so what the bank has actually done is you've got $10 here and you've got $9 here. So they've effectively created an additional $9 on top of the $10 that was injected into the bank. And on the next video, I'm going to go into really briefly what the money multiplier is and effectively how much money can be created out of thin air out of just $10 alone. And so that will be on the next video.